Hello everyone, it's nice to have you here. I'm Josh. In today's episode of our series of explainer videos, How the Platform Works, we will start discovering a new interesting topic, CFD margin trading on IQ option. Since it's quite a big and complex subject, most probably we won't be able to cover all its aspects in one episode, but we'll do our best to shed light on the most important elements of margin trading. And today, we'll explore how to trade Forex CFDs on margin on the IQ option platform. But before we start, we would like to thank you for your interest in our recently published videos. Please feel free to leave your comments below the videos we post. Share your trading experience with us, ask questions, and provide your suggestions on how we might improve our product and service. We do appreciate your feedback and are always happy to hear from you. Okay, let's dive in. First of all, let's find out what margin trading is. Well, as it becomes clear from the term, margin trading implies trading using a margin. A margin is the amount of funds needed for opening and maintaining a leveraged position. Let's stop here for a bit and recall what leverage means. Leverage is a mechanism that allows traders to use extra funds from a broker in order to increase the size of their trades. For example, 1 to 10 leverage means that a trader who has deposited $100 into his or her account can trade with $1,000. Although leverage lets traders increase the size of their trades, and consequently potential positive outcomes, it magnifies losses too, by putting their capital at risk. That's why leverage should be used with caution. The leverage offered by the broker determines the size of the margin. Please note that a margin is calculated automatically by the system depending on the selected quantity of the CFD asset you are going to trade with. Let's take a look at the right-hand side panel of our chart and see how it works. Let's say I would like to trade CFDs on Euro to USD on margin. To open a position, first of all, I will need to select the quantity of an asset, or in other words, choose the number of contracts I am going to trade. When trading Forex on margin, the quantity is expressed in one standard lot. One lot is equal to 100,000 units of the base currency traded. Generally speaking, the base currency is the first currency in a currency pair, the one we see before a slash. The second currency, the one we see after the slash in a currency pair, is known as the quote currency. As we can see here, the minimum quantity for Forex pairs is 0.001 lots. Let's say I'll select 0.01 lots to trade Euro to USD. In this case, the total trading volume will be 1,000 euro converted into the account currency automatically by the platform according to the current exchange rate. To arrive at this figure, we should take 0.01 lots, the selected quantity, and multiply it by 100,000 units of the base currency traded. Please note the amount is automatically converted from the base currency, which in this example is euro, to the account currency, which is USD in my case. So it means the trading volume for my position will be 1,000 euro converted automatically by the platform according to the current exchange rate. Note that the margin is always calculated in the base currency. However, you should keep in mind that although the margin is initially calculated in the base currency, it gets automatically converted into the account currency. So if your account balance is, for example, in USD, like in my case, you will see all the values converted into USD. You should also keep in mind that in some cases, conversion may occur if your account currency is different from the base currency. Alright, in our case, with the quantity of 0.01 lots, the margin will be equal to $36.12. So, it means that for opening a position on Euro to USD with a quantity of 0.01 lots, which is equal to a trading volume of 1,000 euros, $36.12 is needed. This sum is reserved by the broker in order to open a new position. In case the total position is closed out in a loss, a trader is obliged to give this amount to the broker. On the contrary, if the position is closed out with a positive outcome, a trader keeps both the margin and the positive outcome. Now let's take a look at pip value. To understand what it is, we need to recall what a pip is. A pip is short for percentage in point, and is typically defined as the smallest movement in the exchange rate. Most currency pairs, such as the Euro to USD pair, are quoted to the fourth decimal place and can be expressed as 0.0001. However, there exist some currency pairs that are quoted to the second decimal place. These are, for instance, currency pairs with the Japanese yen. The pip value is the estimated value for each 0.0001 point change in the rate of the currency pair traded. To calculate the pip value, you should multiply the trading volume by the pip. Let's take our example. Our trading volume, as calculated, is $1,000. 1 pip for our currency pair is 0.0001, so $1,000 times 0.0001 equals $0.1. So for each 0.0001 point change in the rate of Euro to USD, a potential amount of outcome or loss will be equal to 10 cents, the amount already expressed in my account currency. This is exactly what we see next to the pip value indication. To better manage the risk of your trade, you can activate a stop loss and take profit orders before opening a position. You can also do it during trading if you need to adjust your position parameters on the go. Stop loss and take profit orders may be set in pips or in an amount of money. You can also create a pending order so that the system will open your position automatically once the price of the CFD asset reaches the desired conditions. To do this, enter the price you would like the position to be opened at using the price button. Once the price reaches the indicated level, your position will be opened automatically. Alright, before opening a position, you can check the details of your trade by mousing over the buy or sell buttons. There you will see the open price, the price at which the position will be opened, the quantity of the CFD asset you have chosen to trade with, expressed in lots when trading forex pairs, the pip value, the margin, the leverage applied to your position, the cost of spread, which is calculated by multiplying the pip value by the spread. To know more about spreads, please watch our recent video, 12 trading terms to know, where we explain this term, or watch our video, What is a Spread? Both are available on our YouTube channel. The swap. A swap is an interest charge that a trader has to pay to the broker for holding positions overnight. It can be positive or negative. Once you have decided where the price of the selected asset will move, click Buy if you think the price will increase, or press Sell if you believe it will decrease in relation to the opening price. Once you have confirmed opening your margin position, you will see some additional information below the chart. Let's take a quick look at these parameters. Balance. It's your initial balance before opening a margin position. Equity. Equity is the total value of your trading account. To calculate the equity, you will need to add or subtract unrealized profits or losses and overnight fees from your balance. Why so? If your position has a positive outcome and the applied overnight fees are positive too, you will need to add these values to your balance to calculate the equity. If your position is incurring losses and the applied overnight fees are negative, you will need to subtract these values from your balance. Balance, plus or minus, unrealized P&L, plus or minus, overnight fees. Margin, we've talked about it earlier. I hope we've deciphered this term well. The next one is available. This attribute refers to available margin. The available margin is calculated by subtracting the margin from the equity. Equity minus margin. Simply put, when you open positions, funds from your equity are held as a margin. The rest of the funds are now called available margin, meaning that they can be used for opening new positions. If the trader closes some of the margin positions, they kind of release the margin, so the available margin would increase in this case. And last but not least, margin level. The margin level refers to the so-called health of the account. A healthy account means that there are enough funds to cover the margin that's used for maintaining positions open. As long as the equity can cover the funds held as a margin at least once, then the margin level is considered healthy. You can see that the margin level is expressed in percent. It is calculated using this formula. Margin level percentage equals equity/margin times 100. If your margin level stays above 100%, you're safe. If the margin level falls below 100%, the account enters a margin call state, meaning that any further losses would come out of the funds needed to cover the margin. In order to reach the 100% margin level, the equity must be the same as the margin. In this case, the equity will be able to cover the margin only once. Please note that if your margin level is less than 100%, you won't be able to open new positions. Don't forget to study our special page dedicated to margin trading on our website. There, you will find some examples that may be very useful. Alright, this is all we had time for today. We hope you've learned something new about margin trading on IQ Option. If you found this video stimulating and practical, please like and share it. This will help us to make it more visible to other users. Also, don't forget to subscribe to our channel and hit the bell to get notifications about our upcoming videos. Oh, and one more thing. In the video description, you will find a link that provides you with immediate access to a free demo account on IQ Option. The demo account is credited with $10,000 in virtual funds and allows you to explore the IQ Option platform, practice your trading skills, and enhance your trading approach before you decide to invest real funds. Thank you so much for watching. See you next time. Bye.